Welcome back to our coverage of the JPMorgan 10th Investor Conference happening here in Mumbai. And now I have with me what I would consider two of the most important guests to parse for us the global economy, the commodities and the currency markets. I have with me Oganes, who is the head of global macro research, including currencies and commodities, and Jahangir, Aziz, a familiar face, who is the head of EM economy research for JPMorgan. Gentlemen, thank you very much for pulling yourselves out of this busy conference and giving me time. Louis, the Indian audience has a lot of questions for you on gold. I mean, it's just like a one-way rally. We've 45, 50% rise in a year. Where does this go from here over the, say, next 1 year or two?
It's interesting, Latha, that gold, it took 12 years for gold to go from $1,000 to $2,000 for troy ounce, 4 years only for 2 to 3, and it's going to take, looks like, less than 1 year to go to 4,000. So we do think that 4,000 is within the horizon. In the forecast formally happens in the first half of next year. It could certainly happen before then. And from then, we think that the gold continues to go up. I mean, we have discussed in some reports that in a couple of years we could see 6,000 mark, right? So a lot of things behind that, certainly geopolitical risks, concern about, U.S. Fiscal dynamics, and, the weaponization of the dollar has forced many central banks to start to diversify away from the dollar, the de-dollarization dynamics, and of course, the most recently, the attacks on Fed independence seems to be also fueling the demand for gold. So a lot of reasons why gold seems to be a quote-unquote good refuge.
Okay, so 4,000 looks very much round the corner, and you would not even dismiss 6,000.
Absolutely.
Okay. Would silver be as good?
Well, the difference between gold, silver, or gold in any other metal is that gold, the supply is extremely inelastic. So the possibility to basically produce more because prices are higher is very limited. The mining takes forever, the exploration takes forever, and which is probably not quite the case for silver. So I would say probably the precious metal complex, there's going to be some correlation. But if you want to focus yourself on one bet, I think gold is the one.
Okay. Well, I want to ask about dollar to actually both of you. Let me start with you. Do you expect, Jahangir, that the dollar index will head even lower, considering that the Fed is expected to cut? So two questions, actually. What are you expecting from the Fed, and what are you expecting from the dollar index over, say, a year horizon?
So we started off the year, let's go back to December, when we had the tariff threat. And on that basis, the answer was that the dollar was headed up, appreciating, right? So it turned out that after April 2nd, when we did get the tariff increases, in the first leg was a dollar depreciation. And over the last, I would say, 1.5, 2 months, Luis, dollar has been moving essentially sideways. Now, so while rates have gone up in the U.S., not in the last 2 weeks, but yields have gone up compared to other countries, we have seen the dollar depreciate. Now, both Luis and we made our careers working on emerging markets.
Yes.
So if you ask any emerging market country, why is it that yields are going up and the FX is going down, the answer is, well, that's because the yields are going up because there's an increase in country risk.
Okay.
If you look at it that way, then it sounds plausible that you will see yields going up and the currency depreciating. It is when we go back to the old 80-year framework of looking at interest rate differential and growth differential, then we start scratching our head. That why is it that the dollar, after the initial step down, actually has remained range bound? We still think that the dollar is headed softer. We'll have I think dollar euro at about 117, is at 113 now. All of that heads towards that, but I think we will have to go through the volatility of the dollar remaining and surprising us. But the way we are looking at it is that I'm from emerging market, he's from emerging market. This is what happens when this premium on a country goes up.
Okay, for us it's more important because the rupee is at an all-time low as we speak, 88 and 88.55 or thereabouts. It's really fell a lot today. What's your sense? Does dollar weaken, but rupee weaken faster? It's an outlier.
It's an outlier, and maybe for good reasons, right? There's been several headlines that have generated uncertainty here. We can discuss further tariffs, etc. The rupee is screening cheap, quote unquote, in our models. That doesn't mean that the mean reversion is going to happen very soon because we need some of these sources of uncertainty to clarify. But I think that, as Jahangir was saying, we are cautious on the dollar. We think that there's probably more dollar weakness in store. That, in principle, helps. The dollar is going to be depreciating not only against reserve currencies, but also against emerging market currencies, the rupee included, right? So if you look at the forecast that we have 1 year out, which, of course, is an educated guess, it is marginally stronger than what it is right now. So this is a bit of a signal that, yes, in the near term, probably there's going to be volatility for the rupee, but to the extent that some of these sources of uncertainty clear up and the dollar continues to weaken, that should prove eventually supportive for the rupee.
So the rupee is cheapened enough.
Yes.
All the bad news is in the price.
Yes.
Okay, Jahangir, let me come to the India growth story. Let's not get into the GDP numbers. We don't have it. We have a deflator issue, etc. But on a more qualitative basis, we have adverse impact of the tariffs. Now, almost a tariff on services. But on the other hand, the government has gone all out to encourage consumption. And the first numbers we are getting from auto sales and all is very good, obviously because August was also zero. So do you think that the domestic growth stimuli are more or less neutralizing and the country is on a reasonable growth path?
So let's look at it. Let's pass the tariff impact first, and then let's look at the GST impact. If you look at the tariff impact, if you look at the exemptions that exist on energy, on pharmaceuticals, and on electronics, then the impact is only about 1.1% of GDP of total exports is exposed to the US. And you do any kind of calculation over there, you're not going to get very much of a quote-unquote growth impact. However, that 1.1% of GDP includes textiles, leather, shrimps, gems and jewelry, which are extremely labor intensive. So I think you're going to get an impact where the growth impact is modest at best. But the employment impact is where I think the concern is. And that is where I think one needs to look at. There is going to be a very large employment impact, but it's not going to be that bad of a growth impact. Now, if you look at the GST, which is being seen as a counter-cyclical measure to the tariffs.
What consumption cannot go out,
right.
Let it be domestic.
So let's look at the arithmetic. The arithmetic is that the total amount of decline in GST revenue, as stated by the government, not by me, is 0.15% of GDP. So the increase in household income is just 1.15% of GDP.
1 minute. The numbers were clarified by the CEA yesterday. It is, the compensation cess also has to be included. That's 1.2 trillion rupees, plus GST of 48,000 crore rupees, plus an income tax cut of 1 trillion. So we are looking at a 2.5 trillion.
No, but that's all that you're going to get in terms of household income increase. And then you take 70% of that as consumption and 30% that of this thing. You are going to get a step up in consumption. As long as the step up takes, say, 1 quarter, 2 quarter, it is going to show up as higher growth. But that's it. It stops exactly there. Unless you're telling me that every year GST is going to get cut. It is not going to get cut.
We are hoping that the way in which, for instance, there was a cement producer who says that he sees a clear 1%. If he was bargaining for 5 to 6%, he's now looking at 6 to 7%.
But the other problem is that if you look at, let's say, textiles, India exports textiles which is sold in Bloomingdale's and sold in Bergdorf and Goodman. Gems and jewelry of Sabyasachi is sold in Bergdorf and Goodman. I don't think there are very many people in India who can substitute those things by shifting to domestic consumption. I think we have a problem there. Look, again, I'm not saying that you are not going to get a push on a consumption growth. You have to. You're getting a tax cut. But it's limited only to a level shift.
Well, we are hoping it'll churn the capex cycle, but that question for another day. I want to get two big macro questions out of the way. One is the Chinese disinflation. Okay, let me start with you on that. Do you think that continues? Because now it looks like China is trying to correct some overcapacity, stimulate domestic consumption. Have we seen the worst of Chinese disinflation? Or is there more?
Not really. I mean, if you look at what they call the anti-involution strategy, right, which is essentially saying that I'm going to strongly encourage you not to cut prices, it means that the inventory still remains. You cannot get rid of the inventory. If you're not going to get rid of the inventory, you're going to cut production. And if you're going to cut production, growth is going to fall. So in third quarter, we have already downgraded Chinese growth. We have downgraded, so Chinese growth on a year-on-year basis is going to be about 4.5% of GDP. Next quarter is also going to be about around this thing. But I think that once these numbers come out, I think the anti-involution policy is going to be stepped back because it is actually having an impact on production because you're not allowing inventories to clear. And we have seen demonstrated impact of that in the housing market. In the housing market, they have not allowed the secondary prices to adjust. And consequently, for 4 straight years, you are seeing the real estate market in quantitative terms still adjusting. Real estate investment turned negative about 3 years back. It is still negative. So
short point for an Indian investor who's looking at the WPI numbers getting impacted by Chinese
it will continue
dumping,
that continues to this thing, and therefore, we won't get into the math of GDP. GDP can get boosted simply because of that.
The disinflation is an important input
Yes.
for people making decisions, as is the dollar.
Yeah.
The other big macro issue is over-leverage. The US fisc has gone overboard, so are the European fiscal balances. How will all this impact emerging markets? Are we going to see some kind of a blowout? For the next 2 years, how would this problem impact us?
So there's a couple of things. Certainly the problem of fiscal largesse and high debt that is so prevalent in emerging markets. Now it's also quite prevalent in the developed markets, right? You have seen it, I'm based in London, we see it in the UK, right? The recent problems in France are related to also debt to GDP that they don't know how to contain, right? There's no easy solutions that are politically acceptable. In the US, clearly that is an issue, right? That's why the long end of the yield curve in the US has this term premium, right? And this big, beautiful bill is not going to help matters, right? It runs the risk of increasing the deficit unless growth comes back to the rescue somehow. So what that's going to mean, Latha, is that I think that for the foreseeable future, long-end interest rates are going to remain high, right? So we need to get adjusted to the notion that, hey, looking back the last 10, 15 years, we thought that inflation problems were over and that low interest rates were here to stay. Well, that's not the case anymore, right? So interest rates are going to remain higher. Now, for emerging markets, that the high interest rate in the developed world is never a good thing, right? Because it means that the cost of borrowing goes higher. That said, what we're seeing right now is that capital is looking for places to feel quote unquote safer, right? And there are some emerging markets where the fiscal dynamics are not that bad, are more sustainable, and that they at least have the promise to attract some of this recycling or reallocation of flows.
Do you think FPIs come back to Indian bonds? Will they find Indian bonds attractive?
I think that eventually will, because right now what is happening is that the RBI pretty much is done. The market is pricing some potential for additional cuts. Certainly, there's some risks of growth on the downside, as Jahangir has mentioned, and maybe the RBI seems it in a world in which the inflation is actually quite low in India, right? That maybe they cut further, and that could entice some more capital inflows into India. The issue is that India is facing a lot of competition from high yielders around other countries. I mean, in EM, right? So
whose currencies are not depreciating.
Yeah, no, we're talking about 5.5% policy rate here in India. In Brazil it is 15%, right? And they're going to be cutting. So everyone is salivating at that process, right? So again, competition is hard.
Okay, unfortunately out of time. Other shows are competing, but I would want to detain both of you on another day for a longer chat on global macros. Thank you very much, Jahangir and Louis.
Thanks very much, Latha.
Thanks for having us.
Well, that's it on this edition of It's the Economy. Back to you in the studios, Chartbusters, after a break.